So what is the best way to generate passive income for retiring, and especially from dividend funds and stocks? Well, if you go on YouTube to other channels and look around, you're going to see a lot of people promoting two different methods, both of which I believe have significant flaws. One of them is they promote these really high yielding ETFs that implement these sophisticated derivatives and covered call strategies. Like you'll see funds like YMAX, NVDY, BITO, and then even the likes of JEPI, JEPQ, QQQI, SPYI, etc. And to be clear, these funds are attractive on the surface. They have either exposure to a really hot individual security like NVIDIA or Bitcoin or Tesla or Palantir, or they have a diversified portfolio that's based on like an index like S&P 500 or the NASDAQ 100 or something like that. And so there's this thought that, well, if I'm really bullish on this underlying company and then I can buy a fund that uses this sophisticated strategy that generates yield on top of that, I can have the best of both worlds. I can have this attractive income that I can live off of each month or week, while also having long-term total returns that are pretty solid. And they'll even justify these by saying, look, JEPQ has outperformed SCHD, the Schwab US Dividend Equity ETF this year, or it's outperformed REITs or whatever. So clearly this is a great strategy and I'm generating this huge yield, so how can you speak negatively of it? Well, there are a couple flaws to this thinking. First of all, those funds, for example, JEPQ or YMAX or whatever, they have underperformed on a total return basis by quite a bit the underlying index or holdings that they're based on. If you just look at them since their inception, what they're relative to, or JEPI has done this, QQQI has done this, SPYI, all of them have underperformed since their inception. And that's because they have these, option writing strategies that cap the upside but leave the downside virtually unlimited. And yes, you get a premium that's sometimes quite hefty in exchange for it, but overall, over time, it's almost like playing Russian roulette. Yeah, sure, it helps in certain circumstances if the stock plays perfectly flat, but stocks are not perfectly flat. They tend to go up and down in quite volatile manner. And so with that, you're going to be left behind on the peaks and decline on the faults. And so over time, your NAV is virtually guaranteed to be eroding eventually. And that's, if you look at, for example, YMAX, it's gotten obliterated, or there's even a fund, ULTY, that's gotten, it pays out a huge yield, but its a NAV has gotten obliterated as well over time. And I think on a smaller scale, you're going to see that happen to JEPQ and SPYI, QQQI, JEPI, et cetera, over time. And even like, for example, QYLD, which is based on the NASDAQ 100, that's eroded significantly over time, despite the NASDAQ being in a huge bull market. So that's one big misconception there, that, hey, I'm buying this fund and maybe it is performing well over a period of time relative to SCHD because it's based on an index that's been in favor, or individual stocks have been in favor. But if you're really that bullish on that index or that individual stock, just buy the index or the individual stock. You'll do much better, most likely. Additionally, they charge much higher fees than you would get from just owning the individual index or stock. And that's because there is active management involved. They implemented a capital, a covered call strategy or some other type of derivative investment. So you have fees further eroding your earnings, despite them not even really delivering outperformance in exchange for those fees. So that's an additional consideration. And finally, like I already alluded to, over the long term, it's a pretty unsustainable strategy. If you have a fund that's yielding this incredible amount, it's probably not going to be sustainable over time, or even for very long. As the NAV erodes, there's less of a base upon which to write calls and or do other derivatives. So the ability to generate income is going to dwindle and the yield is going to come down. So that yield is not sustainable anyway. So what's the point of generating it to begin with? Now, some may say, oh, well, I'll just reinvest it in other things. Well, why are you paying fees to a fund to just return your capital to you that you can then reinvest in other things? Just buy those other things to begin with. And then, if you want to have a small amount of this other fund, say JEPQ, for example, to give you some exposure to the NASDAQ 100 and still generate a nice yield off of it, okay, sure, there's a place for that in a portfolio. But to make that the core of your holdings and your retirement strategy based on it, I think it's just risky business, because you're not going to be able to grow the dividend over time to keep up with inflation. That yield is likely not going to be sustainable eventually, and you're probably going to underperform the underlying index anyway. So it's going to be an unattractive risk-adjusted proposition, especially when you account for those high fees that they charge. Okay, what about the other strategy? Okay, SCHD, the Schwab US Dividend Equity ETF, and others like it, like VIG, VYM, DGRO, DGRW, and others. Well, they also suffer from a flaw, and that's simply the fact that they grow pretty well. They generate dividend growth. For example, SCHD is well known for its very impressive over 10% dividend per share CAGR over the past 10 years. Very consistent dividend grower too. It's got over 100 holdings, blue chip stocks. It's got a near 4% yield. So it's got going for it. It's even got the low fee of 0.06%. However, what really hurts SCHD is that its total returns have actually underperformed quite heavily in recent years. So a lot of investors are like, oh, SCHD is not giving me good returns. It's dead money. Or even for some, the 4% yield is just not high enough. And then of course, VIG, VYM, DGRO, DGRW have much lower yields. So if you're looking to retire on dividends, they're not a great option. Now, some would say, well, let's combine JEPQ and SCHD, for example. And that's a decent strategy. You get a pretty good aggregate yield. You do get some dividend growth from SCHD that helps to offset JEPQ's deficiency in that area. But you're still going to be likely not delivering the most attractive risk-adjusted returns that you could. And so this is where my approach comes into play. Before I get into it, though, if you like this kind of content, dividend ETF analysis, dividend stock deep dives, macro analysis, portfolio strategies, and analysis, please subscribe to my channel. I'd greatly appreciate it, and give this video a like. That'd really help in its distribution. Thank you so much. Okay, so what is my strategy that I implement at High Yield Investor? Well, what we do there is we really just scour the high yield space. We filter out all the bad, ticking time bombs, and we find the highest quality companies. And then what we do with those high quality companies, we interview the management team, share those exclusive interviews with our members. We do deep dive analysis. We follow them every quarter. And with all that due diligence, we build valuation models, and then we sit and we wait. And when high quality dividend stocks go on sale within, diversification rules, we will pounce and we will load up. And then as they appreciate back to fair value, we trim and we recycle the capital into another opportunity, and so on and so forth. And so that turns, we're buying a high quality dividend stock that maybe when you do the yield plus growth, has a pretty historically typical total return profile. But then when we do the capital recycling, that brings the capital appreciation part on top of the growth and yield. And so that accelerates the compounding process and boosts our total return profile materially higher than it would have been otherwise. And of course, we'll have some losers, but we diversify so that any one loser doesn't really upset the compounding process, and we can still generate material outperformance over time. And so that's our approach there. And the other beauty of this is that you get the high yield, because again, my weighted average yield in my portfolio at High Yield Investor is close to 8%. And so I'm getting that high yield anyway that can fund my living expenses. I can retire at a young age relatively, but I'm also getting dividend growth because I'm buying stocks that grow their dividends, and or I'm recycling capital regularly from lower yielding, fairly valued ones into undervalued, higher yielding ones. And that is a natural dividend hike that I give myself. So I'm able to get the best of both worlds. I get the lower fees, the dividend growth and sustainability that funds like SCHD provide, while still getting that higher yield that funds like JEPQ and others provide. And best of all, I'm getting total return outperformance of both of those categories of funds. And then of course you can always diversify that. Since I'm already getting plenty of yield from that, I can just buy like SCHG or QQQ or some other type of growth oriented fund to complement it, to get me to that total return profile. So hopefully that makes sense to you. JEPQ, JPI, and others like them, I think can serve a purpose. I would steer clear of YMAX and PLTRY, Palantir's one, NVIDIA's one, all that kind of stuff with the YieldMax version of them, because those are gimmicks. They have these unrealistically high yields. They're just not sustainable. The NAV erodes, and it's a silly deal. Instead, I would buy, if you're going to buy any kind of covered call fund, buy like QQQI, SPYI. There's a Goldman Sachs one that's pretty good. JPI, JEPQ, those ones. Those are fine. Hold them in small amounts to diversify your portfolio if you really want yield from big tech exposure. Otherwise, just buy the low-cost tech focused growth funds as diversification. But then I think it makes a lot more sense to focus on individual stocks. If you want to hold SCHD too for diversification, great, or a fund like that, that's fine too. But if you really want to outperform and deliver attractive yield plus dividend growth, I think picking individual stocks is the way to go. You just got to do your due diligence, insist on high quality companies, and diversify effectively, and then know how to implement a opportunistic capital recycling program. And that's what we do at High Yield Investor. If you're interested, we're actually offering a limited time 20% off Black Friday sale. This is the best sale that we ever offer each year, and you can sign up through the link below. And again, there's a 30-day money back guarantee, so there's really nothing for you to lose and everything for you to gain. So please come give us a look, take advantage of this really limited time offer, and we'd love to see you on the inside. Thank you so much. See you next time.